In investing, edge is a seductive concept. It suggests something rare, valuable, and potent, like an inside line on a horse race or an unfair advantage at the poker table. But in the financial markets, as in gambling, having the edge is only half the game. The other half is knowing how much to bet. Puggy Pearson, a hard-nosed gambler and World Series of Poker champion, once distilled the secret of success into 3 parts: knowing the 60/40 end of a proposition, money management, and knowing yourself. Investors often obsess over the first, finding the favorable odds, but rarely spend enough time on the second, money management, or more specifically, position sizing. This video explores how great investors think about edge, and, more importantly, how they convert that edge into returns through intelligent position sizing. Because an edge that isn't sized correctly is like a Napa Valley vineyard that never bottles its best vintage. An edge in investing refers to any persistent advantage that allows an investor to generate risk-adjusted outperformance. There are generally 3 types. Informational edge, having access to better or faster information. Analytical edge, interpreting information more effectively. Behavioral edge, acting rationally when others are ruled by emotion. Consider Renaissance Technologies, the most successful hedge fund in history. Their informational edge comes from ingesting alternative datasets and executing faster than almost anyone else. But that edge is worthless unless it's sized and scaled intelligently. Renaissance doesn't make 10% bets on any one data anomaly. Instead, it spreads thousands of tiny bets, each with a small edge across vast swaths of the market. Edge without execution is like knowing a horse will win, but not placing a bet. The story of the MIT blackjack team, popularized in Bringing Down the House, is instructive. The team had a statistical edge through card counting, but their real breakthrough was in how they sized their bets when the deck turned favorable. Without proper sizing, their edge would have produced mediocre returns. This insight traces back to Ed Thorpe, the father of quantitative investing. In Beat the Dealer, Thorpe not only revealed how to count cards, but also introduced a mathematically optimal betting strategy, the Kelly criterion, that maximizes the geometric growth of capital over time. Thorpe later applied this logic to investing, founding Princeton Newport Partners, and achieving compounded annual returns near 20% with minimal volatility. His brilliance wasn't just in spotting the edge, it was in knowing exactly how much to stake. Most investors misallocate their capital because they lack a coherent position sizing philosophy. Some concentrate too much on ideas with uncertain outcomes. Others spread themselves too thin, diluting high conviction bets until no edge remains. The most common sizing approaches include mean variance optimization and the Kelly criterion. Markowitz popularized mean variance optimization, which tries to optimize return for a given level of risk. The Kelly criterion, on the other hand, is a formula to maximize long-term wealth by sizing proportionally to edge and variance. The Kelly approach is elegant but fragile. It assumes accurate knowledge of the probabilities and payoff. A small overestimation of edge can lead to ruinous overbets. This is why Thorpe recommended fractional Kelly, especially in uncertain markets. George Soros, in one of the most famous trades in history, bet heavily against the British pound in 1992. His team had conviction, built on macroeconomic fundamentals, that the pound couldn't remain in the ERM. But it wasn't just insight, it was scale. Soros sized the trade massively, earning over $1 billion when the UK exited the system. The edge was good, the sizing made it legendary. Fast forward to Bill Ackman in March 2020. As COVID fears escalated, Ackman bought $27 million in credit protection. His analysis was crisp, his edge strong, but the magic was in the asymmetry. The position returned over $2.6 billion. That's edge with smart sizing. Contrast that with Sequoia Fund's Valiant position in 2015. A high-conviction, oversized bet turned sour when allegations of pricing fraud surfaced. Valiant cratered and Sequoia's portfolio suffered severely. In retrospect, the edge wasn't as strong as believed, and the size amplified the error. Proper portfolio construction isn't just about minimizing volatility or maximizing return. It's about aligning size with edge and risk. Quant strategies like those used at 2 Sigma or Citadel may deploy thousands of micro edges simultaneously. Here, position sizing is automated, optimized, and constantly recalibrated. By contrast, long-term fundamental investors like ValueAct or Trian may place large bets on a few companies where they believe edge is durable and actionable. But even in concentrated portfolios, sizing must account for constraints. Liquidity. Can the position be exited quickly? Drawdown tolerance. Will losses trigger redemptions or emotional reactions? As well as mandate limits. Does the fund structure allow for such concentration? Position sizing isn't just about maximizing returns. It's about maximizing compound returns. The distinction matters. The Kelly criterion explicitly seeks to optimize geometric growth, accounting for the fact that big losses hurt more than big gains help. This is especially critical for funds trying to build multi-decade track records. Ed Thorpe showed that steady compounding with low drawdowns beats volatile bursts. Meanwhile, many tech-chasing funds of the late 2010s ignored this lesson. ARK Invest, for example, bet big on innovation stocks. The 2020 rally made them stars. The 2022 crash exposed the fragility of poor sizing. The edge was questionable, the risk ignored. There are valid critiques of rigorous sizing formulas. The Kelly criterion assumes known probabilities, a fantasy in most markets. It also ignores investor behavior under pressure. Even a mathematically optimal position can lead to psychological pain in the face of drawdowns. Moreover, overconfidence in edge can be fatal. The more you think you know, the more you might size up inappropriately. The antidote is epistemic humility, recognizing that your edge is probabilistic, not prophetic. Great investors are not merely idea machines churning out clever theses or hot stock picks. They are, above all, calibrators, constantly tuning the size of their positions to reflect the strength of their conviction and the nature of the risks involved. They pause to ask themselves critical questions. How strong is my edge? What is the worst-case outcome if I'm wrong? How does this position interact with the rest of the portfolio in terms of exposure, correlation, and risk? And they adjust accordingly, not only the size of the bet, but also their own confidence levels, the timing of their entry, and the expectations they set around the idea. It is this discipline of calibration, not just idea generation, that defines enduring investment success. Edge is only powerful when expressed through intelligent sizing. The difference between a good investor and a great one often lies not in the quality of their ideas, but in how they size them. Like Puggy Pearson at the poker table, great investors understand that knowing when to bet big and when to fold is what separates winners from also-rans. They understand the geometry of compounding, the psychology of loss, and the discipline of restraint. Edge is a spark. Position sizing is the fuse. Together they create fire.